Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I speak with Michael Robbins, author of the new book, Quantitative Asset Management, Factor Investing and Machine Learning for Institutional Investing. This is a wide-ranging discussion about the intersection of finance, data science, and quantitative investment strategies. We dive into some of the key concepts explored in his book, shedding light on how quantitative asset management is evolving in the era of factor investing and machine learning. As always, thank you for listening. Please enjoy this discussion with Michael Robbins. Hi, Michael. Thank you very much for joining us today.
Thanks for having me. I'm glad to be here.
We're going to talk about many of the concepts that you wrote about in your new book, Quantitative Asset Management, Factor Investing and Machine Learning for Institutional Investing. At nearly 500 pages, you certainly cover a lot of ground on a lot of different topics: factor investing, systematic investment strategies, quant modeling, and a lot of other things. And so we're going to try to kind of peel back the onion as much as we can on some of these topics. I mean, our background is in quant investing, and we've had many quant investors on the podcast, but I don't think we've ever had someone that's written such a comprehensive sort of book on all things sort of factor and quant investing. So this should be a good conversation, an educational conversation in many ways. But we were sort of talking at the outset, sort of kidding around that, you might be putting out another book or thinking about putting out another book. But let me ask you with this one, what was the catalyst for you to sort of tackle such a big project?
Yeah, I actually had quite a bit more material than I put in the book. And there are some people who say, why didn't you do this or why didn't you do that? Well, I did. We couldn't include it. It's already huge. But the real reason why I did it is just like you and everybody else. I often go to the web and try to find solutions to problems. And usually it's not there, or what's there is not really informative. And I wanted to address the people who are looking for real solutions, but also people who didn't even know exactly what they were looking for until they read the book. And that includes professionals. In my career, I spent 15 years on a desk before taking my second job. And when I started taking new jobs in new places, I learned so much more than I would ever learn just working at a single bank. So a lot of professionals they have a lot of gaps in their knowledge, important things that they need to know that they don't know. And that's really the focus of the book, to open people's eyes to the things they need to learn in order to be more successful.
No, that's great. And I think, when thinking about how quant investors can sort of develop over time and the trajectory of career, sometimes you can be sort of in the financial world first, and then quant can come in later. To some extent, you hear about people starting maybe from discretionary or having these like horrible experiences, making decisions based on their own emotions and biases and decision-making. And then they gravitate towards quant because they value the disciplined, unemotional aspect of the quant. Or you have some people that are just wired like engineers from birth, and quant is how they think. And then they're exposed to the finance and the markets. And so that's how their quantitative careers develop. I think yours was more sitting in a financial advisor position, and then learning and developing your quantitative mindset as you sort of went on in your career. But I'm just wondering, what do you think, if you were to kind of compare and contrast those two different paths, those two different angles, what do you think the pros and cons are to each in your opinion?
Well, the obvious pro is, like you said, people have all these biases. And one of the key features of these biases is they're really hard to overcome. You can know they exist. They could be staring you in the face and you could still make the same mistakes. And systematic investing is a way to put up guardrails to prevent those biases. But as you mentioned, a lot of people look at it more from a quant lens. And I did get started in quant actually as a nuclear physicist for a short time. And then I quickly started on the other side in investing using quant models. And a chief problem, a really big problem for a lot of quants, and one of my advantages over them was that they are too quantitative, they're too scientific, and they look for the math to solve their problem. And usually the solution really isn't in the math. It's just a tool to find the answer. But you need to really understand the problem, the data, and the solutions that already exist, because plenty of really smart people have tried to solve these problems without computers and are probably more successful. So one of the biggest detriments to people trying to do systematic investing is to be too antiseptic and try to find a tool that'll do this all the work for them. And specifically, one of the biggest problems in designing a quant model is the specification in designing your problem. Uh, Even just asking yourself the question of, what am I trying to solve? If I want to make money, what does that really mean? Do I include stops? Do I include profit taking in my definition of success, rather than just saying maybe 30-day rolling returns? Those are all questions that you need the experience and forethought to use. And a lot of quants don't think that far ahead until the model's already built and it's really too late to go and fix it. They either have to start again or make do with what they have.
Yeah, I think that's such an important point because as I've evolved in my career, like I've gotten a lot better at that. Like thinking about the problem you try to solve, it's so much a function of experience, of seeing all the different problems you see in your career and sort of having that all come together in your head and saying, all right, here's how I want to specify what I'm trying to solve. And to your point, if you get that wrong, everything below it's going to be wrong too.
Absolutely. And even using a model, there are so many discretionary inputs, so many assumptions and parameters that you have to fit. There's just a lot of art in even the most scientific way of investing.
I want to ask you, the book kind of brings together quantitative investing and data science. And most of the people that listen to us will be pretty familiar with quantitative investing and maybe less familiar with data science. So I'm wondering, just to start, can you talk about what data science is?
Yeah. So in the past, say 10 or 15 years, the tools that we have available to us have really become so much more powerful and very accessible. And I think that may be a temporary thing. They may not be the best tools may not be so accessible in the future, but they are now. And so we can access huge amounts of data and alternative data, which is very difficult to manage with a lot of tools. They won't fit in a spreadsheet. And we can use tools to analyze and predict. And so there are data visualization tools, there are regression classification tools. There are all sorts of really interesting uh, data science and machine learning uh, software packages out there that are pretty much freely available. We've heard a lot about ChatGPT lately. There are much more powerful, more structured tools as well. And a lot of people are just starting to get wind of them. They've been evolving for a long time. They're not a revolution, they're more of an evolution. And so using tools that are essentially really powerful statistics, things that can actually learn or fix mistakes in the analysis themselves, are available to us now to do much more sophisticated analysis than we used to do with, say, point and figure charts and, rolling returns and moving averages.
Do you think this is something, I mean, quants like us have used this type of stuff for a while, but do you think this is something that most managers are going to have to use going forward? I mean, taking advantage of this vast amount of data that's out here and, figuring out how to process it properly. I mean, do you think that's something that's going to pretty much everybody in the industry is going to have to start using?
I think it's been going on for a while. The whole idea of uh, scientific beta or smart beta uh, is pretty relevant in that the more and more these tools are able to do things that people thought only people could do, the less and less that value is alpha and the more of it is beta and reproducible by a machine. In reality, there's not that much that people do that has so much value that it can't be replaced. And that narrow bit of value is going to become smaller and smaller as the machines become more and more capable and scalable. And we've been seeing that a lot, even in the past few months, when these open source tools are starting to get put behind walls. And hedge funds and big banks are really figuring out how to scale them and use them for things that people normally do. there'll probably be some things that only people can do for quite a long time, maybe even forever. But most people are not that creative. And a lot of what people can do can be replaced by a machine that's much quicker. So yeah, I think to a large part, some traders who are not that creative are going to get pushed out of the market.
That's interesting, that idea of doing what people do, because I've always thought that quantitative systems were at their best when they do the things that people do, when they can kind of analyze and think about things factually the way people can, but take the emotional part out of it. Because obviously the big problem with people is all the emotional decisions. So maybe we're moving more towards here where they can do more and more of what people do, and we still can keep that emotional thing to the side, hopefully.
Right now, the best way I think to use them is to do the things that people don't do well, which is handle large amounts of data or manage really complex relationships or work with incredible speed. But they're getting sophisticated and they'll take up more and more of what we now consider creative. I'm sure you've had these experiences. I have, and I've read a lot about them. Sometimes I think of something that I think is new and I realize I thought about it 10 years ago. I just forgot I thought about it, right? A lot of what we think about is a lot less interesting and creative than we give it credit for.
What do you think the long-term impact? I mean, many people have talked about what machine learning is going to mean to investing. And obviously it's being deployed right now by a lot of people. It's not like this is the future, this is the present. But what do you think the long-term impact of machine learning will be on the way quantitative strategies are run?
I think a lot of investing is going to turn more and more into the high frequency trading model. And the high frequency traders have become more like factories than traders. They try to increase their speed more than their creativity. And they invest a lot in machines and technology and access to get that extra speed. They benefit a lot from scale, from being able to have a lot of money to spend on this technology. And probably the most sophisticated, fastest, most capable algorithms will be managed by companies like that. Occasionally, you might come up with someone who does something completely new and turns the market upside down. But for the most part, I think a lot of trading is going to gravitate towards a few large shops that compete with each other. There may be some space for longer term thinking or more abstract trades or things that rely, say, on reading people's facial expressions during earnings calls or something, things that computers aren't that good at. But a lot of it, I think, is just going to be a war between superpowers. But that's a ways off.
Yeah, that's been amazing to me. Like the idea of the war of superpowers, how little like edges they're trying to get, like the little bit faster computer, or a little bit closer to the exchange, or a little bit faster data. Like all of that is what they're battling each other for, and it makes a huge difference because they can execute in so many milliseconds that like the one that's just slightly ahead of the other, wins.
Yeah, absolutely. And one of the key themes of the book is finding a niche, right? So if you can look at something that the machines haven't looked at yet, that may not even be worth their while, it's way down on the list of the things they need to do, then you might be able to survive for quite a while and earn a lot of money. When I started managing money, I did arbitrage, and we targeted a trade that could make maybe 10 or $100 million. It was not enough money for the big shops to compete with us, but it was complex enough that the amateurs couldn't do it. And so we found a little niche where JP Morgan and Goldman Sachs wasn't trying to eat our lunch, but there were a lot of people who didn't know how to calculate what we needed to do to get the trade done. And that was our niche. So a lot of what I put into the book is expanding people's understanding of the markets and of the tools they can use, not necessarily giving them a recipe to use them. So they might say, oh yeah, I haven't thought about debentures, or I haven't thought about, AT1s. Maybe I should look at that market because maybe there aren't a lot of people with eyes on that. Similarly, they might say, well, everybody's using scikit-learn, but they're not using this other algorithm. It looks promising. So just to give people ideas of how to find those niches so that they can compete in a world where everybody's looking at Apple using regressions and moving averages.
Yeah, I think that's so important because the idea of finding an edge is so important in investing, and the edges are getting fewer and fewer farther between. If I go out and try to start like Jack's high frequency trading shop to compete with Citadel, I'm in huge, huge trouble. Like I have zero chance of doing that. So like finding these smaller things That's so important because everybody is applying quantitative strategies right now, and they're doing it with high powered computers, and you have to find your spot, I think that's the biggest challenge.
Yeah, absolutely. And most of the examples I've found and most of what I hear people talking about are those really kind of boring and mainstream trades. And the reason why is because people only have a certain amount of time or space to explain themselves. So they have to use an example that it can be explained in that space. That's why the book is so long and why it was so much longer before I cut it down, because I tried to push that envelope to talk about the things that people don't normally talk about. And to that point, I was just talking with a friend of mine, Ryan Weil at National Institutes of Health. And what he does is part of what he does is in his cancer research, he takes algorithms that people use on normal sized computers and use giant, enormous building sized computers to tune them and to test them and to use them on data sets that their authors weren't able to. And he can find algorithms that work much better than their authors think, just because he's able to use them with more power. So there's opportunities even in the most boring mainstream things if you can find a novel way to do it.
One of the interesting things I found in the book when I was reading it last week is this concept of stacking premia you introduced pretty early in the book. And you introduced the idea of the equity risk premium and all the different individual premia it can be broken into. So I'm wondering if you could just talk about that, because I found that interesting.
Yeah, that goes to the bare concept of factors, which you know well. The idea behind factors is to talk about something that's kind of pure and easier to comprehend and forecast. I mean, even factors are pretty hard to comprehend, but if you break up a return into its different components, and those components are explainable and interpretable, something that you can really grapple with, then you can do a better job of trying to forecast it. If you look at just say an individual stock, there are so many things that change the price, things that are impossible to forecast and things that just pollute all the ideas that you're using to try to make sense of it. Breaking down those forecasts into digestible bits, like interest rates and inflation and things like that, it doesn't necessarily make it easy, but it does make it more tractable. And as you mentioned, you can stack them. So you can divide your problem up, tackle it one bit at a time, and then put it back together to try to form a fair value. So it's an incredibly powerful way to go about things. And a lot of people don't do it. A lot of people try to forecast, say, the S&P 500, which is an amalgamation of so many different forces that are just so difficult to estimate in general. And so by using factors and specifically by using risk premia, you're able to separate it out and make an easier forecast.
Could you just talk about when you broke down the equity risk premium in the book? I thought it was interesting, the individual components of that. Can you just talk about what those are?
Yeah, so I got the idea from some people I know in the business, economists. And when they want to forecast, say, the S&P 500, they do more of a bottoms up than a top down analysis. So they may look at each individual stock, right? Look at the stock's financing rate, their equity portion, their bond portion, forecast the demand for the equity, the supply for the equity, the different classes of equity, what's been locked up. If you just break up the overall return into all these different minor forces and try to analyze them one at a time, then aggregate them up for that stock, do it for the other stocks in the S&P 500, aggregate that up to the sectors and the sectors to the index itself, then you can get a much more nuanced and reliable forecast. And it's also more defensible. And that's a big part of what I talk about in the book as well. A lot of quants who rely purely on quantitative methods, when they start losing money or their CEO or their clients put pressure on them to break out of their strategy, they often fall back on their algorithms. And a lot of them are very secretive. They think that if they talk about their algorithms too much, it'll be stolen from them. So even falling back on it is not as bad as the people who fall back on it and then can't explain it. But what I talk about is when you use factors and risk premia and things like that, you have something to talk about to your clients. You have a way to defend your strategy and say, well, we tested this, we thought about this, we still believe in it. So just hang on. Nothing has changed. We just hit a rough patch. And that is a big value in that sort of thing as well.
One of the things I was thinking when I read the book is it clearly is helpful for practitioners who are building quantitative strategies because you've got, basically everything you would need to know in there. But I was thinking if you flip that too, it's interesting. So if you think about it from the perspective of somebody who utilizes these strategies, you could probably pull out the most important things you need to know when you evaluate a quant manager. I'm just wondering if you could summarize, like, what do you think those are? Like, if you were looking at a quantitative manager and deciding to invest with them, what are the most important things you would look for?
Yeah, you're exactly right. I wrote the book from the opposite side of the table, but you can get pulled out of it. Right? I wrote it for people who want to be managers who maybe haven't run a hedge fund before, but they worked at a bank or a prop shop, and just to evaluate what they need to do to be attractive to people who want to hire them, whether they're asset allocators like pension funds or just RIAs. And so, yeah, there are a lot of things, and it's basically about avoiding the red flags, right? Because one red flag can just sink the whole relationship. So something like key man risk, where you have one person who's absolutely necessary to run the fund. If you don't have a key man, it's a non-event. But if you do, it's a huge red flag. Whether you can get the financing you need to sustain your project, how you source the ideas, whether it's repeatable and reliable. But really, the most important thing is to create some trust with the person who's evaluating your product. Because no matter how much history you have, no matter how well things back tested, how many boxes you check, they still have no idea whether you're going to perform in the future. They only know what you've done in the past and what you present right now. So if they can trust you, that goes a long way. And for a lot of people, that's hard. For a lot of quants, they're not that socially interactive. Some of them are. But if you don't have a really salesman-like persona, you can kind of go through the checklists I write in the book and present yourself really well. For one example, I talk about risk triggers. So when that became really important was during the great financial crisis. And I was working at a large pension systems then, and we had some top-notch pension managers that we invested in that made some big errors during that period. And we flew out to see them. And basically what we told them is, we don't really understand your process. We don't know how you're protecting our capital. We really want a set of rules that you have to follow so that we can trust that you're not going to get frozen like a deer in the headlights. That we know that if your AUM drops by a certain amount or volatility increases by a certain amount, you're going to have an investment committee meeting. You're going to give us a call. We want some rules written down to assure us that we can trust that you're going to manage it well. Not that you're not capable. You're great hedge fund managers, but everybody sometimes drives off the road. And we want to know that we can trust your process. So it's even more important for a small manager to show that if something goes wrong, their investors will find out. So I talk a lot about those things that I think they're very reassuring during a due diligence analysis.
Yeah, what's interesting to me is to some extent, if you're investing with a quant manager and they have sort of a black box system, that could be good because they've got something maybe that other people don't know about. But the flip side of it is if they've got a black box system, you could have some sort of blow up. You have no idea what's going on. So you could have some sort of blow up. So it's like this balance, you want to make sure you know enough about what's going on that you can make sure something catastrophic is not going to happen.
Yeah. And I talk about that a bit too, which is, it's good that you brought it up. Professional asset allocators have seen all different kinds of systems. What you think is a black box and is unique is probably only slightly different from what they've seen 100 times before. And if you're cagey about your strategy, they're just going to have distrust. If you tell them about your strategy, you're almost certainly not telling them enough for them to reproduce it. As we were talking about earlier today, there are so many little decisions you have to make about how you fit your model, about what your inputs are, how you condition your data, how you build your features. Somebody could know everything you want to tell them about your model and still not be able to reproduce their results because there's so many little intricacies. So that's a big problem a lot of quant managers have when they get interviewed in due diligence, is not being clear and honest enough about what they're doing. They're not going to give up the shop, but they could create a lot of distrust.
Before I shift it back to Justin, I want to ask a few questions about factor investing. I don't know if you're familiar with Larry Swedroe.
Of course.
Yeah. So we
Right.
had him on, and he's got all the P's of factor investing, like all the things to determine whether a factor is a good factor. But everybody we've talked to kind of who operates in factor investing kind of comes at this from a different direction. So I wanted to ask you that same question. Like, what do you think makes a good investing factor?
Yeah, I definitely have different philosophy from him, although he's unimpeachable in his ways. But like you said, there are different ways of thinking about things. And I'm much more quantitative and much more into the weeds about it. And since I do deal in a lot of industries, when I look at machine learning, I see that some industries are very successful at doing things that would not be successful in finance. For instance, bioinformatics looks at lots of different transformations for features and basically data mines, which is a big red flag in investing. We need our factors to be interpretable and explainable because we have to sell them to our clients. Right? We have to be able to explain them when things are going poorly. We have to be able to explain our strategy clearly to raise capital. And so it's difficult to talk about something esoteric. It's much easier to talk about something like an interest rate factor. And so it's not essential, but it gives you that leeway to maybe survive some losses when they happen and to weather some rough times. So interpretability and explainability are really important. Investability is very important, which sounds obvious, but it really isn't. I mean, you can't invest in pure factors usually. And so it's very easy to spend a lot of time forecasting something that you can't invest in and then having a huge implementation gap, turning that factor forecast into an investable thesis. There's lots of other detailed ways that factors have to be evaluated, especially for finance. Certainly how they might invalidate assumptions that their models rely on, like autocorrelation and multicollinearity and things like that. It's very nuanced, but certainly it's important to think about the bigger picture about how your fund is going to raise capital and survive, not just how it's going to create a successful backtest.
It's interesting because, in our world of long-term factors, like the idea that it makes sense is essential. Like to think it's going to continue to work, you want to have some sort of explanation as to how it makes sense. But I'm interested, like on the shorter term side, I remember there was a quote by Robert Mercer from Renaissance, and he said something along the lines of, the factors that have been the most successful for us over the long term make absolutely zero sense. So, maybe on the short term part of it, maybe that's not true because maybe, those would be replicated out and you don't want it to make sense. So you don't want to be able to explain it. So what do you think about that?
Yeah. I think he's speaking to a different audience. If you're in milliseconds, you don't care what the fundamentals are. You just want to capture that dislocation and you're fast enough to do it. What you mentioned is really important, but not always reliable in that if you have some economic intuition, if you're a smart trader and you understand the markets, you want to understand your factors so that you think that they'll persist over a long period of time. And something you don't understand either means that you have a gap in your understanding of the world, or there's something wrong with it. But there's definitely a middle ground. And I talk about this quite a bit. It's that you have to transform your factors so that the machine understands them. And that may require some unintuitive things, right? You may have to scale it from 0 to 1 instead of 0 to 10 million. You might have to take the log of it or remove the minus sign or any number of very simple transformations that to a human being are inconsequential. It just wouldn't change the thought process. But to an algorithm makes all the difference in the world because these algorithms at their very essence are actually pretty naive and they can be fooled by things like different ranges. If it has two different variables and one is from 0 to 1 and the other one ranges from -1 to +1, it might completely foul up the analysis. To you and me, that it doesn't matter. We just adjust for it in our minds. So these essentially nonsensical transformations that you and I would think are non-intuitive might be very, very important, even in the long term. But still, I agree with what you originally said. It helps a lot if they make sense so that we can give a sanity check to our algorithms and feel more comfortable that they'll survive over the long term.
Going back to the longer term factors like value and momentum, one of the things I struggle with a lot is this idea of factor timing. I feel like, when value's out of favor and value spreads are very wide, it should be an opportunity to invest more heavily in value stocks and get a better long-term return. But then when you look at the data, it pretty much says you don't want to get involved with that. So I'm just wondering, what are your thoughts on like the concept of factor timing?
Yeah, Cliff Asness writes a lot about this, and he's a brilliant writer. I have the utmost respect for him. I don't always agree with him. And the same is true for the like active versus passive investing philosophical wars. Timing is possible. It's really, really hard. And if you can find a niche or a time frame, a frequency where you can do it, you probably can eke some stuff out. It's not for the faint of heart. It is really difficult, but it's a lot of fun, and lots of people have made money on it. There's this concept of meta modeling, which is really fun and interesting, where you could have a series of machine learning models, like you would have traders on a trading desk or managers in a multi-manager fund. And you could have a machine learning model that chooses when to allocate to which ones. So you might have a manager that's really good in up markets. You have another guy who's really good at short selling. One guy is great when interest rates are going up. Another guy is great for recessions. And the meta model will analyze all the submodels and allocate money to them appropriately when it thinks that the timing is right. And there's sector rotation models. JP Morgan writes a lot about that in their institutional research. Amazing stuff. Wolf Research does a lot of great research on that stuff as well. I mean, there's tons of fun models and things that you can read about how to do it. But it is hard. It's definitely hard. And I would wait to be a professional before I put my whole nest egg in it.
Yeah, going back to Cliff Asness, I always think of his idea of sin a little when I think about
Exactly.
factor timing. Like if you're going to do it, it's probably best to do it in small amounts and not to go all in on value when it's out of favor or something like that.
Yeah. And that's important that, value is a special factor in that it has so much intuition behind it, and it makes so much theoretical sense that people treat it as if it's a law of nature, but it's really just a factor. And even if it were a law of nature, it doesn't persist in the short term because people are emotional and emotions drive the market. So even if it's absolutely an ironclad factor, you could run out of money long before you realize the profits from it. So you have to treat it just like any other factor.
Yeah, to that point, I try to never think of almost anything as like 100% certainty in investing. Like, obviously those of us who invest with value believe that over the long term it's going to work, but the odds it's going to work over the long term are not 100%. There's some odds there that it's going to work and some odds that it's not. And so I think it's important to always think about stuff like that, because otherwise you get trapped in not seeing the other side of anything. If you think there's a 100% chance anything's going to be happening, you don't ever look at the other side and you get yourself in trouble.
Yeah, I do talk about some models that are mechanistic, that are deterministic, like arbitrage models, where eventually, say at the expiration of a futures contract, things really do have to converge. The problem with those models is usually they have so many moving parts that you can't lock every part down, and you have to take some sort of risk, or they're so ephemeral that you have to be a high frequency trader to actually get it done in time. But for the most part, for the models that people normally think about, yeah, that's true. They're all just very subjective at their core.
Just one more for you before I hand it back to Justin. You had an interesting classification of models in the book. You had they classified among data models, scoring models, and functional models. And I'm just wondering if you could just talk about what those are and how they relate to each other.
Yeah, absolutely. I was kind of alluding to that just a minute ago, in that data in general has lots of problems. There are spikes, there's missing data. It's not at all straightforward to fill in those obvious errors or what might appear to be obvious errors, or to say oversample minority data. So the data models are really, really important and very often overlooked. On the other end, the deterministic or mechanistic models are also not as common and can't play a dominant role. For instance, the way that VXX is rebalanced, or the way a treasury cash and carry arbitrage is works. Most people focus, say, on the scoring models that rank trades or overweight or underweight trades or identify trades. But there's a place for all of them. And that kind of goes back to the theme of finding a niche and expanding your universe of tools that you can use. The more models you're aware of and the more implementations you know about, the more chance there is that you can try something that not everybody is looking at. I would normally shy away from the things that everybody is talking about and look at the things that are maybe less explored or ways to implement them that other people haven't tried yet. We're now working with some GAN models to produce synthetic data. And that's really difficult because most of these models are not designed for time series data. And even the ones that are designed for time series data are not appropriate for financial time series data, which has a lot of perks on their own. So trying to apply really interesting models in novel ways is a great way to do this. I saw one model that I thought was pretty genius. What they did was they showed it was an optical model, one that's used for classifying images. And they showed it images of different technical analysis patterns like wedges and head and shoulders, things like that, and had it optically characterize these different patterns rather than trying to program into it whether there was a double top or something like that by looking at the price action. So, and in that way, they were able to access these convolutional models that were really only used primarily for images. So there's a lot of really interesting things that can be done right now. The world is really your oyster in terms of getting low cost, really powerful technology and having a lot of things that people don't seem to have tried yet.
That's really interesting. Like thinking about instead of looking at the data behind a chart, just look at like a lot of pictures of charts and try to teach the model based on the pictures of charts. Like I've never seen that before, but that's really interesting.
Yeah. There's a few papers on that. It was a really interesting way to do it. And it kind of goes back to what we were talking about a few minutes ago, to play to the algorithm's strength. Don't try to force it to think like a person because it can't, but help it do what it does best. For instance, categorizing images, and see if you can benefit from that.
Going back to like traditional factor investing for a couple minutes here. So, value has had a rough decade and basically a half. So you could probably go back to the financial crisis and, value stocks have had fits and starts here, but for the most part, they've vastly underperformed growth stocks, particularly mega cap growth. And so I'm just wondering, like, in thinking about the period we're in, but also thinking about like the long-term premium of value, how would you tackle the question of does, systematic value investing still work? And how would you approach sort of that question?
It- I think the fundamentals of it make a lot of sense, and the intuition behind it is indisputable that strong companies will survive in the long term. The problem is, especially recently, that psychology, which is basically momentum, has really dominated so many things. And also, unless you are really prescient, things like the recent hype behind AI, which has driven lots of these big tech stocks, these mega cap stocks, are really hard to predict within a certain time frame. You may have a long-term forecast for it, but you need to really pin it down in order to benefit from it from an investment standpoint. So value is really being wagged by the tail right now. And it's hard to determine when it will become in and out of favor, even if it does make a lot of sense. Another thing about it is, to be successful in the market, you have to out forecast your peers. It's not enough just to think that something's going to do well. You have to think that it's going to do better than everybody else thinks it's going to do, which means you have to do some sort of unique analysis or come up with a unique thesis. And that may involve alternative definitions of value or getting data from alternative sources. So people have been mining regulatory filings for a long time. Then they started mining social media. I'm sure people are already looking at the faces of CEOs and, whether that's determining their emotions, whether they're lying or not. There's lots of different ways we can use technology in a more nuanced way to cast a broader net on value. and to make it more effective. Uh, but the old tools just aren't enough to cut it on a reliable, repeatable way, unfortunately, as much as I think a lot of people wish they would.
Yeah, to your point, we've had a few times on the podcast a gentleman named Kai Wu who's done a lot of sort of machine learning, natural language processing on trying to calculate an intangible value factor, since more of the value of companies is now in, intangible assets, human capital, patents, the culture of the company, and trying to use natural language processing and text analysis to sort of uncover that. So, I agree. It's like, and I think like your point that you keep bringing home about this creativity, like thinking sort of creatively, in the quant space, in different data sets, looking at things differently, it really resonates with me because you got hundreds of or thousands or tens of thousands of super smart people all competing sort of maybe in the same space. It's like, how do you find where that, where the edge can be? Anyways, that's a point you brought a number of times.
Yeah, yeah, and it's always foremost in my thoughts. And this is probably kind of a trivial observation, but I did a little work in electronic warfare, and investing seems to me like a very close analog to that. Uh, when you look at Kahneman and other people's work about heuristics, they don't apply to investing because investing is really a battle where people are trying to outdo each other and even to fool each other into doing things and making mistakes. And you constantly have to innovate and find new ways. You can't rely on these old factors. They become less effective and sometimes actually work against you. You have to always be looking for new data sources, new ways to interpret things, new definitions of things like value in order to be able to compete because it's adaptive and it's expected. You have to estimate what you think is going to happen in the future and adapt as things change dynamically and quickly.
And maybe one of the ways to handle that, and I was thinking of Larry Swedroe again, and he has this chart that shows, over 1, 3, I think 5, 10, and 20-year periods, the underperformance of various factors. So value, profitability, momentum, maybe qualities in there and size. I think that's something like that. And that, a multi-factor, and that all of those can go through long periods of underperformance versus, the market. But that when you combine those factors together, you can sort of start to limit those underperforming periods. And the reason that's important is because that's what investors can actually stick with. That's what they can stay with. Because if they go through, for 3 years of underperformance, forget it. You're talking 5 years or 10 years, there's not going to be anybody left. But I'm also thinking like in terms of running quantitative models, like it's pretty powerful to think about if you have a set of quantitative models, maybe they're in the same asset classes or different asset classes, the way that you can sort of manage that tracking error or risk of dramatic underperformance is by combining those different models, like in an ensemble like approach, for example.
Yeah, yeah. I mean, it depends on your time frame and your skill level. So if you're a high frequency trader, you don't really need that kind of ensemble because you're just hitting the trades constantly. If you have a really long-term strategy where your particular trades can go in and out of favor between rebalancing periods, then you're better off diversifying a bit. But you don't want to, as they say, over diversify and to diversify away all your alpha. If you have real skill, then you want to focus on a narrow set of opportunities, right? If you're a heart surgeon, you want to bring in a bunch of other, doctors like a foot doctor to opine on your heart surgery to diversify your opinion, right? You're highly skilled. You know exactly what you're doing. You don't need anybody else's opinion. But if you want to manage somebody's health over time, over their lifetime, they might need heart surgery, but not their whole life. They may have problems with their foot or their stomach or their brain. So you want an ensemble of doctors to diagnose them. So it really depends on what you're doing and how good you are at doing it.
There's that saying that no one's ever seen a bad back test.
Yeah.
And you dedicate some time in the book to talking about back tests and what people and practitioners and investors should be aware of and on the lookout for. Can you just comment on some of those things?
Yeah, that's a big part of what I try to do in the book is to show all these different ways that you can make a really critical and nuanced back test. And there's just so many of them, you can't do them all at once. So you have to pick and choose which ones you need. And that's a bit of art and a bit of honesty. But things like modeling the transaction costs in a very accurate and detailed way, including market impact, uh, analyzing the rebalance periods, the slippage, and there's so many different things you can do in your back test to make it more true and more predictable out of sample. And most of it, a lot of it, I haven't been able to find in other sources. It's not that professionals don't know how to do it. I didn't invent these techniques, but they're not really talked about much. And if you're honest with yourself and you really want to create a back test to see if you're going to make money, then you have to implement some of these really complicated and nuanced factors into your back test. So I try to show people at least some ways to do that so that they can be more accurate in their back test and not disappointed when they go live, which, like you said, happens very frequently.
What is your view on, and this may not have been in the book, but I'm just curious. We had Jim O'Shaughnessy on the podcast, and he wrote What Works on Wall Street. It's like the seminal book about, simple quantitative strategies. And he back tested initially, I think it went back to the 1950s. They've since run the strategies back to like the 1920s, I believe. But, we talked to him about when they tweak or change a strategy. And, for him, they do it very rarely, but when the long-term evidence suggests that it's, makes a strategy more robust and it makes sense, they have in the past sort of tweaked the models and the various factors that they use. But I'm just curious, what is your view on that? Like, you have a strategy, you've tested it over a long period of time. Maybe you've implemented it in the real world. You have out of sample data with it, but then, is your view that strategy should be continuously improved, or when a strategy is in place, do you kind of lock it down and just let it run and just let these strategies do what they're going to do? Where do you fall on that?
Yeah, so I do have my own opinion. It differs from Jim's, although again, I would not want to contradict him on his own opinions, but I'm in a different circumstance, and adapting and improving is a big part of what I do, provided it's really well researched so that it's not just changing for the sake of changing. But essentially, I think it goes back to the idea that you should create an investment thesis and you should change when that thesis is violated, either on the upside or the downside. If you're making a lot of money, more than you predicted, maybe you should stop because you're doing something wrong. You just don't know what it is yet. And you've been lucky to benefit from it instead of to get hurt by it. But you nonetheless are out of your envelope. And obviously the same thing is true if you're behaving poorly. A really interesting technology that's starting to become very useful and effective is this causal modeling, which was recently, over the past 20 years or longer, I think, popularized by Judea Pearl. But there's been a lot of companies that have been implementing it. And the idea behind it is if you can draw a flow chart, which mathematicians call a graph, of a process, and that flow chart has obviously events and arrows, and those arrows contain a process that takes you from one event to another. If you can draw one of those flow charts, this theory can not just interpret tendency the way statistics do, but interpret causality. So you don't come up with these spurious relationships that one thing happens, another thing happens, but you're not quite sure if they're really related or not. This says, yeah, they really are related. And the benefit to that is if you create one of these causal maps, is that if any of those arrows are broken by something you didn't anticipate, say a Fed action or COVID or tsunami or what have you, then it can instantly flag if your theory is violated and stop. Or it can reroute along one of the other paths that it thinks is not violated. Right now, there are a lot of limits to these theories. They're used in things like spam blockers already, but one of the chief limitations is, I'm pretty sure, right now they only work on graphs that have two really essential properties. One is that they're called directional, meaning that they have arrows that all point in a direction. And the other is that they're acyclical, meaning there's no loops, that the output doesn't affect the input, which is true of almost all economic models right now. There are feedback loops, so they can't really be used on a lot of theories that people have. And that's kind of the reason why you might not have heard as much about them lately. But I think they will overcome those limitations and become a really amazing and effective way to invest that will provide paths for improvement and, more importantly, provide indications when theories are violated and when people need to pull the plug on their model or adjust their maps, that they're making decisions based on different factors than the one they were relying on before.
Yeah, and then there's probably like dozens or hundreds of those types of flows that can be happening, those cause and effect relationships. But I could also see from a discretionary manager's view how something like visual like that would be very valuable to see the things influencing and then think about, what was I missing? I know we're talking quant here, but I'm just thinking discretionary as well. Seeing that visually could be, I think, a powerful thing possibly.
Yeah, I mentioned something like that in the book reluctantly because I didn't want to insult qualitative thinkers because some of the best investors are qualitative thinkers. And I don't mean to deride that. But I think for most people, they're not as quantitative as they could be just because they don't understand themselves as well as they could. Quantitative analysis is essentially more about understanding yourself than putting something into a formula. If you can draw that mind map, if you can draw that flow chart, it means you really understand what you're talking about. And people may make good decisions, cognitively without having that process that clear in their mind, clear enough that they can draw a diagram. But it really does help. And for those of us that are not geniuses, that can't just intuit these amazing things, being quantitative just essentially means you're more thoughtful and you've gamed things out. And honestly, you're more reliable as a steward of somebody's money. I talk about it also in the first part of the book when I mention business cases and investment policy statements and due diligence questionnaires. I talk about writing these things partially because a lot of people require them before they give you a lot of money, but mostly as a tool to guide you through thinking through your business, thinking through your process, and understanding and coming up with alternative solutions so that you can survive bad times.
We haven't talked a lot about sort of the risk management aspect of these quantitative models or building quantitative models, but can you just speak to that and I guess the importance of that both for those developing these models and also for those investing in these types of strategies?
Yeah, risk is absolutely essential. It's very complex. There are many, many different measures of risk that you have to combine in a mosaic to come up with a true measure, a true understanding of how your portfolio is vulnerable. And that's the measurement side. But very importantly, there's the management side, and that has a lot to do with emotions and strategy and process. And that's some of the hardest parts of investing. And there have been many books written on how to manage your risk when things go poorly. And I talked about that a little bit, but that's just a whole career in itself. And, but very, very essential and something that you really need to think about long and hard and work with diligently to try to overcome your emotions and basically a lot of cues that might lead you astray.
So we like to ask our guests, and by the way, this has been great. I think we probably could have gone for a whole nother hour. We like to try to keep these within a certain amount of time, but I mean, certainly as you look to do uh, other pieces of research, other areas of quantitative investing, I mean, you're welcome back, Michael, because this has been
Thank you.
a great discussion. So really appreciate your time. And we like to ask all of our guests the standard closing question. You can go anywhere with it. I have a feeling it'll probably be in this quant space, but if not, that's fine too. Which is, if you could teach one lesson to the average investor based on your experience in the markets, what would that be?
I think taking ownership of your process sounds like something that's simple, but a lot of people don't really do it. And to your point, specifically in the quant space, a lot of people rely on their tools or rely on some back tests and don't really take ownership of the results. They think they do, but they really don't. And that's something I was taught early on. My first mentor on Wall Street was a psychologist by training, and what he told me about his thesis was that he postulated that a gambler and somebody who is just paralyzed by analysis have really the same personality in terms of a trader. And that personality is that they don't take ownership, they don't take responsibility for their actions. So the gambler will say, "Oh, I lost money because I got a bad break. I had bad luck." And somebody who is in analysis paralysis will just keep on analyzing, and they'll be afraid to just kind of stop and do the best they can with the time they have. And the way he explained it to me was that he needed somebody working for him that would do it as much as he could up until a point, and then to pull that trigger and get that trade done. And even if the trade failed for reasons that were out of his control, because if he only took that little extra bit of time, maybe he could have solved it. It doesn't matter. You have to take ownership of the results because it's ultimately your decision. And that's a hard lesson for a lot of people. And a lot of people hide behind quantitative strategies just to avoid taking ownership of things and to rely on the algorithm. But you can't get away from it. You can diversify away your responsibility with algorithms or without.
Great. Thank you very much, Michael. Is there obviously the book is, as we mentioned at the beginning, Quantitative Asset Management, Factor Investing, Machine Learning for Institutional Investing. Does the book have a companion website? Are you on Twitter? Where else can people go to find out more about you and the book?
Yeah, absolutely. I was really lucky. I got the book's name as the website name, quantitativeassetmanagement.com. And I have lots of resources on that website, computer code, data, videos, lesson plans, all sorts of things, lots of references that I couldn't include in the book because it's not an academic book. I also have a Twitter account, but I haven't updated it much lately. I apologize to say, Michael C. Robbins. I have lots of other outlets that I hope to add some social media to, but really the book's website is the place to go for more information about the book and also for more information about upcoming books. You can also email me there with questions or requests or collaboration.
Great. Thank you very much, Michael. Best of luck with the book.
Thank you. I really enjoyed being on your show. Thank you very much.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.